anti-flipping rules for selling residential property across Canada are coming out on January the 1st of 2023, among all the other things that are happening on January 1st of 2023. Just in case you haven't been paying attention, there's a little bit of stuff about to happen at the start of 2023. And one of those new things is the anti-flipping rule or tax that is going to be imposed on anybody selling residential real estate starting next year. All you flippers. In fact, the CRA is not waiting around for January 1st. They are going after people actively right now who they think are skirting the rules, including the story of some Toronto homeowner, and it didn't turn out too great for them. Between 2011 and 2016, this person sold 4 homes, but it was the sale of her property specifically in 2011 that was the most contentious. And interestingly enough, this is past the 3-year kind of assessment period that the CRA usually pays attention to. And they also wanted to introduce a penalty for something they called gross negligence. I'm going to let you know what happened in this story, where it went wrong, and all about what's coming up on January 1st of next year. If that sounds interesting to you and you're a property flipper, you definitely want to watch this video. Let's get into it. What's good, everybody? It's Darren German from the German Group, where, hey, we know you've only got one chance to either buy or sell your next home, so we're here to help you get it right. There's a subscribe button right there, and guess how many subscribers we have as of today? 543 as of the time of filming this video, and we'd love you to be the next one. So do me a favor, hit that subscribe button if you're interested in getting real estate content, local real estate content to Surrey and surrounding areas, as well as any information we can provide to help you be a better homeowner, a better home seller, or a better home buyer. Sound like a deal? Sounds like a deal. You're also going to want to hang around to the end of this video because not only am I going to let you know to the end of this story and how it worked out for this Toronto woman, but I'm going to let you know how to get access to our free PDF for you if you're looking to buy a home, about 7 colossal tax breaks that are available right now, and you don't want to miss out on them. All right, so let's maybe start this by talking about what the principal residence exemption is and why that's important to understand. When a home qualifies as a principal residence and you sell it for a profit, this means your profits can be tax-free by claiming something called the property residence exemption. Get ready for a Flintstones reference. Let's say our good friends Wilma and Fred bought a property for $500,000 and lived there for 5 years. Now, they sold that property 5 years later for a profit of $100,000, selling it for $600,000. Pretty good, right? Because they actually purchased this home to be a principal residence, they actually did live there, and they made some profit on this property, they actually get to be exempt from paying a capital gain on that property, meaning getting taxed on the profits that they made. Pretty good deal, right? Disclaimer. Since every situation can be specific, this information should not be relied upon as legal, financial, or tax advice. We strongly encourage you to speak with a qualified accountant to determine specific implications, if any, to your own personal situation. Love, the German Group. Interestingly enough, we're one of the only countries that doesn't tax the sale of a principal residence if you realize income on that. As an example, our friends down south, yeah, they pay capital gains tax when they sell their principal residence. And yeah, of course, there's some exemptions to that, but for the most part, most people pay it. The next piece, I guess, to really jump into is when you're flipping properties as a business, trying to make money off it and trying to do it above board. It doesn't matter if it's 1 property you do per year or 100 properties per year, the CRA is going to look at it exactly the same. Are you ready for a Family Guy reference now? Our good friends Peter and Lois go to buy a rental property, and using the same numbers, they purchased this rental property for $500,000, $500,000, and own it for 5 years, eventually selling it later down the road for a profit of $100,000 or a total sale price of $600,000. Well, they made $100,000 worth of profit on this. So minus any expenses that they may have incurred during their time of ownership, effectively that $100,000 is going to be taxed at a rate of 50% put towards their income for that tax year. There's all sorts of calculations that are kind of needed to figure out how much tax they would owe from their day jobs, but this is considered by the CRA to be a business, and therefore this is taxable income that they are going to have to pay up on. Again, not an accountant. Talk to your accountant if you're worried about your own situation, right? This leaves us with the third group of people out there. You've got the people who buy and actually live there. You've got the people who buy, don't live there, use it as a business and report it. And then you've got the third group, which is the scammers. Don't scam the CRA. That is bad, bad news. Many times in the market, people will buy a property and claim it as their principal residence, but they have no intention of living there. They just want to renovate it, flip it, and make a profit. While there's nothing wrong with doing that, improving a property to sell to somebody else, that's not a bad thing, but it is a problem when they do it and they try and skirt around the tax implications of doing that. An example of this is pretty easy. Let's say somebody buys a property and they put $150,000 worth of renovations into it, and they put it up for sale 3 months after they bought it and sell it for a profit of $250,000. So they really made $100,000 after they did their initial renovation. They think just because they sent their mail to the property and just because they moved into the property that they shouldn't have to be subject to this tax, which is of course paying capital gains on the profits realized. Well, this is gone pretty quick. The new rule changes that are coming up say that if you do not live in a property for 365 days, they are getting very specific about this. And this used to be a little bit of a rule that people thought you had to be there for a year, but that wasn't actually the case. That wasn't written down. But now with this new change coming up in January, on January 1st of 2023, you have to be in there for at least 365 days before you can consider it a principal residence if you sell. Of course, there's going to be exemptions to this, like maybe if somebody passes or there's changes to a family dynamic, like unfortunately a divorce happens or something like that. But for the most part, that's not usually why people sell when they're doing this stuff. If you're curious about the exemptions, I will put them below. So there you have it. But what happened to our friend in Toronto? I promised you to fill you in on the remainder of the story and how that really played out for her. Fortunately for this lady, it was found that she was in a tumultuous relationship from the period of about 2010 to 2014, and she ultimately ended up divorcing her partner in the year of 2015. She argued that because of this, she was moving frequently, thus her home sale in 2011 was related to a lot of the back and forth moving that was happening, and it was a principal residence, so she shouldn't have to pay the tax. The CRA disagreed. They said it was an adventure in the nature of trade. Thus, the income should be treated as business income, and she should be responsible for the entire amount. And I forgot to mention that she made a huge profit in selling this home in 2011. Huge. They had an interesting case against her as well because she never changed her home address at all, and she never claimed that she even sold the property on her tax forms. So ultimately, what was decided? The court had to make a decision, and they had some guiding questions about how they would formulate their answer that I will link a link to the article below. But did she misrepresent her property sale? Did she actually have gross negligence, which is a penalty above and beyond what she would have owed in her taxes due? The judge determined that she really failed to meet the description of an actual real estate flipper. She wasn't a real estate agent like myself. She wasn't somebody in the business of doing this, or at least it didn't appear that way. She was actually a school teacher. With all the back and forth that this lady experienced, the judge ultimately found that she did intend to buy the property as a principal residence, not as a capital property to make money. However, there was one caveat to that. The next question was whether that property was actually considered a principal residence at the time that she bought it and thus when she sold it. The judge went on to say that the gain was taxable because it was not her principal residence, concluding that while she may retrospectively believe the property to have been her permanent domicile, her present belief cannot assuage to the CRA's assumptions without some additional evidence. So she owed the CRA some money because it wasn't her principal residence. Thus, she should have paid the taxes on it. Fortunately for her, and this is kind of an unfortunate story in terms of what she was experiencing with her family life. Luckily for her, she didn't experience the gross negligence penalty that the CRA was also going after. So I guess that's a good thing. So that's what happened. Pretty interesting, right? So again, come January 1st of 2023, this is when these new rules come into effect. And I am so curious, what do you think? Do you think these are good for the real estate market? This is going to apply to things like assignment sales. This is going to apply to, of course, property flippers. Leave your comments below and let me know what you think. At the start of the video, I also promise you access to our information that I think you're really going to appreciate if you're someone who is looking to buy a home, or maybe you've already bought a home. You definitely want to take advantage of this. And that is 7 incentive programs that save home buyers thousands. And you probably want to save some money if you just bought a home. These are 7 government incentives that you can take advantage of in 2022 and into 2023 that you want to, because you don't want to give away more money than you have to. Buying a home is kind of expensive. The link's down below to access the information. And while you're down there in the description, be sure to take a look at the link for our calendar as well. If you're someone that feels maybe a little lost with either the buying process or the selling process, or you're just looking at getting your toes wet to get ready for something coming up, you're able to book a call directly with me. And hey, I'm happy to lend an ear and see what I can do to help and set you off on the right foot. Guys, I'm Darren German from the German Group. I want to thank you for watching. And hey, don't forget, you've only got one chance to either buy or sell your next home. So we're here to help you get it right. Thanks for watching. Thanks for subscribing. And I look forward to seeing you on the next video. Cheers.